Hi, my name is Shai Finkelstein, and I will present you the equity research presentation regarding FedEx Corporation. It all began with Fred Smith's economic paper while in college, where he envisioned and analyzed that society became more automated. Computer companies would need to ensure that their products were dependable. Computers could not make business cheaper, faster, and more accurate unless they could be fixed rapidly. Their manufacturers would need a nimble logistics and delivery system to keep their customers happy. From this dream, from this paper, Fred Smith created a multi-billion-dollar business. FedEx Corporation, ticker FedEx, recommendation neutral. Price on report date $108.59. Price target $116. Forecast horizon 12 months. Target forecasted $116. I would like to share with you some of the highlights for FedEx Corporation. The modern air-ground express industry was pioneered with the founding of Federal Express in 1971. The corporation was created in 1998 as FedEx Corporation and became FedEx Corporation in January 2000. Profit improvement initiatives are tracking ahead of expectations. Management reiterated its profitability target of $1.7 billion despite the challenges in Express. Some highlights from the financial summary. Market capitalization $34.37 billion based on data reported as of 9/9/13. Dividend yield 0.6. EPS 6.20 reported on data as reported on FedEx website under Investor Relations. Summary of analysis. FedEx is positioned in a very strong place and have some very favorable results. However, Express profitability remains low, reinforcing the need for greater cost discipline and capacity reduction. In addition, the complexity of the overcapacity in the air freight industry and the ongoing trade-down from international priority to international economy creates uncertainties. FedEx is still one of the top companies that, even with its anemic financial returns, will likely influence more favorable future shareholders' outcomes. My recommendation for the next 12 months is neutral, as there are too many factors that can affect its attractiveness. A positive turning point would be, in my mind, if FedEx would provide more dividends and/or buybacks. Qualitative analysis. Company profile. FedEx provides customers and business worldwide with a broad portfolio of transportation, e-commerce, and business services. It offers integrated businesses applications through operating companies competing collectively, but at the same time managed collaboratively under the respected FedEx brand. Consistently ranked among the world's most admired and trusted employers, FedEx inspires its more than 290,000 employees to remain absolutely positively focused on safety, the highest ethical and professional standards, and the needs of their customers and communities. What kind of services do they offer? FedEx Corporation is in a way divided to 4 different components: FedEx Express, FedEx Freight, FedEx Ground, and FedEx Services. Each one of them operates independently but collaboratively under the FedEx brand. Who are the customers? Its customer base is comprised of large corporate, government, small and medium-sized companies, and individuals. FedEx ships to almost everywhere in this universe. The U.S. logistics and transportation industry overview. The logistics and transportation industry in the United States is highly competitive. By investing in this sector, multinational firms position themselves to better facilitate the flow of goods throughout the world's largest consumer market. International and domestic companies in this industry benefit from a highly skilled workforce, and relatively low cost and regulatory burdens. Spending in the U.S. logistics and transportation industry totaled nearly to $1.3 trillion in 2011. A highly integrated supply chain network in the United States links producers and consumers through multiple transportation modes, including air and express delivery services, freight rail, maritime transport, and truck transport. To serve customers efficiently, multinational and domestic firms provide tailored logistics and transportation solutions that ensure coordinated goods movement from origin to end user through each supply chain network segments. In a video interview with the Wall Street Journal in May of 2012, FedEx CEO and Chairman Fred Smith commented that the uncertainty in the global markets, especially in China and India, poses challenges to the entire industry. Any report must have a SWOT analysis, which means trying to analyze and examine the strengths, the weaknesses, the opportunities, and the threats that the company faces. FedEx is well positioned in the leading company in its industry. FedExing becoming a term that shows the strength of the brand and its reputation. FedEx has a variety of services to cover a large gamut of needs by their customers. The company ground segment is continuing to drive earnings over the near term as the company's network density and enhancement drive continued market share gains. I expect e-commerce and B2C, namely business to customers growth, to continue to generate substantial revenue gains that should outstrip overall trucking demand growth for the foreseeable future. In addition, they have a very good reputation in customer service and commitment to communities. Weaknesses. The company's express profitability remains depressed, reinforcing the issue of greater cost discipline. The risk-reward profile is much more balanced given the previous rally for their shares. Opportunities. I would like to share with you two main opportunities. A. Profit improvement initiatives tracking ahead of expectations. Management reiterated its profitability target of $1.7 billion despite the challenges in express trade down and macro uncertainty. In addition, FedEx's recent announcement of their completion of the first stage of a strategic acquisition by signing agreement to acquire the business operated by its current service provider, named PTY Ltd. In 5 countries in Southern Africa, FedEx will be able to expand its market share and to expand their services. Threats? The proposed merger between UPS and DHL in Europe can take some market share and drive profit margin down. In addition, slower than anticipated benefits from planned cost-cutting initiatives can affect the short-term profitability of the company. The global international decline in shipping that began in 2011 continues to contribute to the uncertainties. Porter's 5 competitive forces was really covered by my SWOT analysis. However, as you can see on that slideshow, there are some additional considerations that we need to think about when we recommend buying or not buying FedEx stocks. Management. We begin with Frederick W. Smith as the Chairman and President and Chief Executive Officer for FedEx Corporation. As you can see in this slide and some of the few other slides, you see a short bio, some background of each executive for FedEx Corporation. In the next slide, you see names of all major holders in FedEx Corporation, as well as top institutional holders. I would like to share with you some of the exciting news from FedEx Corporation. FedEx reported higher year-over-year first quarter results on September 18th. FedEx Corporation reported earnings of $1.53 per diluted share for the first quarter ending August 31st, compared to $1.45 per share last year. FedEx Express remains focused on reducing costs while facing challenging global economic conditions. Meanwhile, FedEx Ground continues to generate strong profitability on growing customer demand for its services. In addition, in February of 2013, FedEx announced its early voluntary buyout plan, which will save the company $600 million by fiscal year of 2016. In December of 2012, FedEx offered employees up to 2 years' pay to leave. It's seeking to reduce annual costs by $1.7 billion by 2016. The company said that it was pessimistic about the US economy, but confident about growing its own earnings. Now, we should examine and analyze the financial ratio analysis. This financial ratio analysis has been computed based on FedEx income statement, balance sheet, and key statistics of May 2013 via Yahoo Finance, as well as some other sources. Short-term solvency. Liquidity ratio indicates the company's ability to meet its short-term obligations. The current ratio is more than 1, which is good, as the company has more assets than liabilities. The quick ratio is also good, as many assets are available to pay immediate debts. Cash ratio is also relatively positive and good. Long term. This ratio indicates company ability to meet its debt obligations from cash earned. FedEx uses 48% debt and 52% equity for its long-term financing. Both time, interest, and cash coverage ratio are high and indicate that the company is able to easily meet its debt obligation, which means that FedEx, from that perspective, is in a good position. Assets utilization. This ratio indicates if the company uses its assets efficiently. The turnover ratio indicates that FedEx uses its asset efficiently to generate sales and convert it to cash. The receivable turnover and days sales in receivable shows that the company collected outstanding credit accounts and reloaned the money roughly every 8 days and collect credit sales in roughly 46 days. The total assets turnover indicates that the company is doing an okay job, not a great job, of use of its assets to generate sales. Profitability ratios. These ratios indicates efficiency in use of assets as well as efficiency in operations. The profit margin means that FedEx generates 0.035 per dollar from sales. It appears to be low. The ROE is also not so high. The company's use of its assets and operations should be examined internally and also must be compared to other companies in the industry in order to get a clearer picture. ROE. Market value ratios. Market value is based on the price of $108.59 of May 31, 2013. Based on price earnings ratio, the company sell its shares 22.11 times the company's earnings per share. The value for stockholders is almost twice, which is pretty good. It's a nice value. In this slide, you see the ROE using the DuPont analysis for FedEx Corporation. When we compare the ROE for FedEx of 2012 to 2013, we do see a decline. In 2012, ROE was 13.19%, where in 2013, it was only 9.6%. This is obviously a matter of concern, as it indicates a decline in generating profit on every dollar in equity in an accounting terms. In the financial terms, FedEx experienced a decline in a financial leverage. When we compare the ROE of FedEx and UPS ROE, we do see that the ROE for UPS is still higher than the ROE for UPS. Nevertheless, the UPS merger with DHL that may happen or may not can create some threat to this leading position of FedEx. As you see in this slide, we see a chart of comparison between FedEx and UPS. The earning per share forecasting into 2014 can be shown on this slide. In my own individual risk survey discussion, I received a minimum score of a high tolerance for risk of 33. I believe that part of it is due to the nature of the questions that were asked, but perhaps it also will influence my decision in my recommendation to buy or not to buy FedEx stocks. My recommendation is neutral. The financial status of FedEx looks stable and hopeful, but nevertheless, the challenges that they face as a result of the mixture of the following items make it neutral for the next 12 months. Express profitability remains depressed, highlighting the need for greater cost discipline and capacity reductions to reach current expectations for 25% EPS growth in fiscal year of 2015. Risk-reward profile is now balanced, given the recent rally in shares. The stock has appreciated 34.3% over the past 12 months, outperforming the S&P, which is up 18.2%, while we can expect global freight flows to show an upward growth. The path is likely to remain choppy due to the uneven economic recovery. The continued uncertainty that shakes the confidence in the earnings outlook is due to the overcapacity in the air freight industry, which will be complicated by the ongoing trade down from international priority to international economy. Counterbalancing the uncertainty in Express is the long-term bullish view of the company's ground business, which operates at superior margins within the group. Management reiterated its profitability target of $1.7 billion, despite the challenges in Express trade down and macro uncertainty. One of the key reasons is due to its success towards its profit improvement initiatives, including the early voluntary buyout plan, which will save the company $600 million by fiscal year of 2016. Notably, FedEx raised its initial guidance from $500 million. In this slideshow, you see the earning per share and the net income forecasting. One thing that I would like to share with you is what it seems to be at first glance a discrepancy between the calculation of 4.93 EPS and what is reported as 620. And I think that part of the difference lies in the concept of diluted EPS, diluted earning per shares. In terms of forecasting, I think that for 2014, the earning per share will most likely grow to $6.80 or to $7 due to an increase in net income that originates from cost discipline and efficiency. So, in conclusion, there are many opportunities for growth in revenue for FedEx in the next 5 years. However, for the next 12 months, the uncertainty of global markets and internal issues make it neutral. In conclusion, if you currently have FedEx stock, hold on to it. If you do not currently possess FedEx stock, it's really up to you to decide if you would like to wait for a while to see real returns, or if you would like to buy now and hope for the best.